Hello, I'm JIANG, and welcome back to Silver Signals, where we cut through the noise to find the high probability setups that the institutional players are trying to hide from the retail crowd. We are standing at a critical crossroads this morning, March 15th, 2026. And if you are looking at your screens right now and feeling a sense of complacency because of the recent cool down, you are likely about to miss the most significant directional shift of the first quarter. This isn't just another minor retracement. We are witnessing a massive liquidity grab as XAGUSD and XAUUSD react to a surging DXY and a shift in Fed rhetoric that has caught the broader market off guard. After seeing gold flirt with those $5,500 levels and silver screaming past $120 earlier this year, the current flush down to the $80 to $81 range for silver and $5,023 for gold is a calculated move designed to shake out weak-handed speculators before the next leg of this secular bull market begins. To understand why this moment is so pivotal, we have to look back at the historical framework and realize that 2026 is fundamentally a different animal than the peaks of 2011 or the geopolitical spikes of years past. While the 2011 run was driven largely by post-GFC currency debasement fears, today's price action is anchored in a structural supply-demand imbalance that the world has never seen before. In 2011, silver's industrial utility was a fraction of what it is today. Now, we are looking at an environment where the AI boom has reached a fever pitch, requiring massive silver loading in high-speed data centers and specialized semiconductors that simply didn't exist a decade ago. Combined with the relentless expansion of the solar sector and EV infrastructure, which have both hit record production tiers this year, the silver deficit is no longer a projection. It is a physical reality that the COMEX is struggling to manage. Even with the current 3.92% slide in silver prices, we are maintaining a floor that would have been unthinkable 2 years ago, signaling that the smart money is using these dips to accumulate rather than distribute. Taking a look at the macro picture on the monthly chart, the trend remains impeccably bullish despite this localized turbulence. We have spent the last several months carving out a massive base, and this recent pullback from the $120 peak in January to the current $80 level represents a necessary healthy correction to fill the fair value gaps left behind during that parabolic move. Moving into the daily time frame, the structure shows we are currently testing the 50-day moving average and key Fibonacci retracement levels where the bulls are fighting to establish a new higher low. On the 15-minute chart for this New York session, the volatility is palpable. We're seeing heavy wicking at the $80.50 support level, which suggests that institutional whales are running stop losses below the recent swing lows to hunt for liquidity. This is a classic liquidation hunt, and as a professional trader, you must recognize these bull traps for what they are: orchestrated attempts to drive price lower into high demand zones before a rapid reversal. As we navigate this volatility together here on Silver Signals, it is vital that you stay informed on these rapid shifts, so please take a moment to like this video, comment below with your personal price prediction for the end of March, and subscribe to the channel to ensure you never miss a deep dive update like this one. The strength of the US dollar has certainly put a temporary cap on the metals, especially as the latest CPI data has cooled expectations for immediate Federal Reserve interest rate cuts. But this correlation is likely to decouple as geopolitical tensions in the Middle East continue to simmer in the background. Central banks are not selling their gold. In fact, the sustained demand at the $5,000 level for spot gold suggests a global reweighting of reserves that provides a permanent tailwind for the entire precious metals complex. We are essentially watching a high-stakes game of chicken between the Fed's higher for longer narrative and the reality of a global industrial shortage of silver. The technical levels to watch for the remainder of this session are $78 on the downside, which represents the ultimate line in the sand for the current bullish structure, and $84 on the upside, which is the immediate resistance we need to reclaim to signal that the correction is over. If we see a daily close above $84, the path back to triple digits becomes much clearer. However, you must be wary of the stop-loss hunting that typically occurs around these psychological levels. The market thrives on the pain of retail traders who over-leverage at the wrong time. This is why I stress the importance of understanding the supply-demand imbalance created by the 2026 AI infrastructure build-out. The industrial floor for silver is rising every single day, regardless of what the DXY does in the short term. The current cooldown is a gift for those who missed the initial run-up, provided you have the discipline to trade the charts and not your emotions. In conclusion, while the headline numbers show a decline, the underlying fundamentals for Silver Signals followers suggest that the long-term thesis is stronger than ever. The transition from $120 down to $80 has reset the oscillators and prepared the market for a more sustainable move higher as we head into the second quarter of 2026. Keep a close eye on the 80.54 support zone in the coming hours. as a bounce here would confirm that the institutional accumulation phase is nearing completion. Thank you for tuning into this deep dive. The fundamental narrative for 2026 is no longer about store of value alone. It is about the physical impossibility of the modern world functioning without silver. When we look at the industrial demand landscape, we are witnessing a perfect storm where silver has become the critical bottleneck for the triple pillar expansion of AI, green energy, and high-spec aerospace. In previous cycles, industrial demand was a steady, predictable baseline, but the 2026 AI boom has fundamentally re-rated the metal's floor. Every H200 and next-generation Blackwell equivalent chip requires significantly higher silver loading for high conductivity packaging and thermal management compared to the silicon of 5 years ago. We are seeing a structural shift where the tech titans are now competing directly with bullion banks for physical delivery. This isn't just about jewelry or coinage anymore. This is about the backbone of global computation. Furthermore, the solar sector's transition to TOPCon and HJT cell technologies has increased silver intensity per watt, meaning that even as we scale up gigawatt production, we are consuming more ounces per panel than the previous decade's projections ever accounted for. When you factor in the massive EV infrastructure rollout in the USA, where silver's role in sensors, power management, and charging stations is non-negotiable, the deficit we're seeing in 2026 isn't a temporary glitch. It's a permanent feature of the new economy. This industrial urgency is painted clearly across the monthly chart, which remains the most important tool for any serious Silver Signals member to master. When we pull back and look at the macro trend, the massive multi-year breakout from the $30 to $50 range that we saw in 2024 and 2025 has now created a generational base. The current monthly candle, despite its retracement toward the $80 level, is actually retesting the top of a decades-long breakout zone. From a technical standpoint, we are looking at a classic break and retest on a grand scale. On the monthly time frame, the RSI had reached extreme overbought territories near 90 during the $120 peak in January, and this current cool down to $80 is simply the cooling of the engines needed for a sustainable move toward $150 and beyond. If you look at the monthly volume profiles, the selling pressure on this dip is significantly lower than the buying volume that drove us up from $50, which tells us that the major institutions are not exiting their core positions. They are simply letting the market breath while they reload. The monthly 10-period and 20-period moving averages are still pointing nearly vertically, suggesting that the underlying momentum of this secular bull market is nowhere near exhausted. As I always say here at Silver Signals, the monthly chart is the truth, while the lower time frames are often just noise created by the whales to trigger your emotions. We are currently seeing a massive confluence of the monthly Fibonacci 0.382 retracement level, sitting right near this $80.54 mark, which often acts as a springboard in high momentum markets. The fact that we are holding this level while the DXY is at a multi-month high is a massive signal of relative strength for XAGUSD. I want everyone watching to really digest this. In 2011, when silver hit $50, the industrial demand was roughly 500 million ounces. In 2026, we are looking at industrial demand projections exceeding 850 million ounces against a stagnant mine supply that has been underinvested for a decade. This is why the monthly chart isn't just showing a price spike, it's showing a repricing of a scarce commodity. Please make sure you like this video, comment below with your specific thoughts on the industrial deficit, and subscribe to the channel so you can stay ahead of the curve as this macro thesis plays out. When we consider the Fed's role in this monthly structure, even a higher for longer interest rate environment struggles to suppress a metal that is being physically consumed at record rates. The institutional liquidation hunts we see on the daily and 15-minute charts are ultimately futile attempts to fight the monthly trend. As the New York session progresses today, remember that the smart money is looking at these monthly support zones to build positions that they intend to hold for the rest of the year. We are seeing a transfer of wealth from the impatient to the patient, and by staying anchored to the industrial fundamentals and the monthly macro view, you are positioning yourself on the right side of history. I'm JIANG, and this is the level of depth you can expect every time you tune in to Silver Signals. If you want me to do a dedicated video specifically on the silver loading requirements of the newest AI chips or a deep dive into the 2026 mining supply crunch, let me know in the comments. I am JIANG, and it is a privilege to help you navigate these markets. Don't forget to like the video, share your thoughts in the comments on where you see XAGUSD heading next, and subscribe for more elite level analysis. I would be happy to provide a more specific breakdown of the silver to gold ratio or a detailed look at the latest COMEX inventory reports if you'd like to see that in the next video.